Ever thought you found the best trading indicator only to get disappointed? You are not alone. What if there was a way to scientifically prove which indicator truly rules them all? Welcome to another episode of Algo versus Crap, the series where we cut through the noise with real data. If you've ever stumbled upon the countless videos on YouTube testing trading strategies with mediocre methods like manually analyzing 100 trades on a single instrument and a single time frame, then you know it's time for a change. And I am here to make this change. Today's indicator that's going through this rigorous test is Williams R. This isn't just a review of Williams R indicator, but it is a rigorous test on Williams R on multiple markets, different speeds, different exits, to find out if it is good enough to use it in our strategies. Plus, we will be comparing it to other indicators that we did in previous tests. So don't forget to check the Algo versus Crap playlist in the description below. Williams R developed by the trader Larry Williams. He's an accomplished trader and he developed many indicators. This is one of them. It is kind of similar to stochastic, where we are comparing the close relative to the highest high and lowest low in a previous period. The indicator ranges between 0 and minus 100, and this is a kind of unusual for an indicator. So an oversold value will be minus 75 and an overbought value will be minus 25. There are no positive values in the Williams R indicator. And here is the formula. The highest high of a previous period minus the close divided by the highest high of the same period minus the lowest low of the same period multiplied by minus 100. So this is an example. If this line is the highest high represented by this one, and the red line is the lowest low representing this low, and currently we have this close. Imagine we have these values. So the highest high is 100, the lowest low is 90, and currently the close is 92. So the equation will be as follows. The highest high, which is 100 minus 92, our current close, divided by the highest high, 100 minus the lowest low, which is 90, times minus 100. And if you resolve this equation, currently we have minus 80. That means currently we are in oversold. And of course, we can see it from the picture, it's oversold. And this is how it looks like on the chart. So here I have the futures of the S&P 500. And at the bottom, we have the Williams R indicator. So currently, this is a 20-bar look back. So these bars are representing daily time frames. So currently, we are looking at the previous 20 days. And here I have below 75 as oversold and above minus 25 as overbought. Remember, it's from 0 to minus 100. Now, the indicator, as all oscillators, can be used in two ways, either as a mean reversion strategy, where we buy when the price is oversold and we short when the price is overbought. Or we can use it as a breakout strategy. So we sell, we short basically when the price is oversold, and we go long, we buy when the price is overbought. But since we are trading the S&P 500, we will use it as a mean reversion strategy to go long when it is oversold. So this strategy currently with the 20 bars look back and minus 75 and minus 25 are the levels. We have 87 trades with $737 on average. Our performance, we are making $64,000 with 1.2 return to drawdown ratio. This is how the strategy looks like. And here is the annual returns. Now we are going to optimize the strategy. So the look back, we will go from 5 to 25, step 5. And then the oversold from minus 65 to minus 95, step minus 5. And overbought from minus 5 to minus 35 with a step of minus 5. So overall, we have 245 combinations. These are the results. And let's look at a 3D graph. So currently we are looking at the oversold values and the overbought values. So the overbought is where we are exiting and the oversold is where we are entering. And then the z-axis is the net profit. And currently this level is about 150,000. And here we have the look back period. So this is number 5. And obviously all of them are profitable. I mean, even this red, this is about 100,000. And this is beautiful, stable area. And if we look at the other values, so this is 10, it's currently below, 15, again, 20 below, 25 below. All of them are below. So 5 is the best. But remember, even 25 is still profitable, but it's around 50,000. So 5 is the best value. And then for entry, we have from minus 65 all the way to minus 90. And then for exit, I would say between minus 20 and minus 5. And this area is all stable area. So if we go back to the spreadsheet, and if we sort by return to drawdown, we can see the top is all 5 as we saw from the graph. And any strategy will be good. So for example, this one, it's average trade 721, 273 trades, but now we're making about 200,000. And if we look at this strategy, this is the periodical return. It's much better than before. The graph, of course, again, is much better, and the trade analysis. Great. Now that we understand how Williams R indicator works, we tested on a single instrument. Of course, it works very well. Matching the style to the S&P 500 will always work. We know this from many other videos on the channel. Now we are going to take it through rigorous testing in the algo versus scrap workflow. The workflow for algo versus scrap is as follows. First, we tune every indicator to 4 speeds: extremely fast, fast, normal, and slow. The extremely fast speed will deliver 400 trades or more in a 10-year period. And then the next speed will deliver 300 trades, the next speed will deliver 200, and the slowest speed will deliver about 100 trades per 10 years. Now I do this so I don't optimize as the best values for the indicator, but I do it to optimize it for this number of strategies so I can easily compare with other oscillators. Next, we test direction. So we will test long separately from short. Again, this will deliver a focused result on the pure performance of the long side and the short side. Number 3 in the workflow is strategy type. We will use mean reversion and breakout. So like I showed you in the screen, we can use the oscillator to buy the oversold, or we can use it to go short when it's oversold. So it's either mean reversion or breakout. Now, why do we do this? Because the mean reversion strategy is exactly the opposite of the breakout strategy. So I'm not depending on matching the indicator with the instrument, like in this case, I'm matching it with the S&P 500, because I'm testing different markets and I don't know which one will work. Number 4, we have exits. I am testing 3 exits. Exit number 1 is the first day, so we enter and then we exit the same day. Exit number 2 is 4 bars. So we enter and then we exit after 4 bars. Exit number 3 is a stop loss and a profit target only. And the stop loss is 4 ATRs, while the profit target is 2 ATRs. And I do this so that they don't overlap and we get, some weird trades. And finally, point 5 in the workflow is the market. We will test all these combinations on 66 different markets. The 66 futures markets are in different sectors. They are in agriculture, crypto, currency, energy, equity index, and meats, metals, and softs. So the combinations of the exits, the entries, the direction, the multiple markets will give every indicator more than 3,000 strategies. So that is really good statistical number to base our conclusions on, especially when we can compare it to other 3,000 strategies per indicator. So to give you an idea about the data that I collected so far, it's 22 indicators tested on 66 markets using the workflow steps that I mentioned. And total currently is about 70,000 strategies with above 13 million trades. And of course, that is a huge database that we can easily conclude which indicator is doing the best. So if I filter for Williams only, we get 3,164 strategies, about 1 million trades. This is only covering Williams R. So the top rows that are in dark blue are only for Williams R, and the bottom for the light blue are for the whole database. So currently Williams R represent 4.5% of the number of strategies of the whole database and 7.2% of the whole number of trades. Now, these strategies are not fully developed strategies. I'm only testing the edge of the indicator in a certain speed, certain direction. So remember, we are using it to go long and short, mean reversion and breakout, and using different exits. So we are not using the same indicator to exit. We are exiting either on the same day, which will produce obviously low profits, and after 4 bars that will produce better profits and the stop loss and profit target. The idea is to gauge the edge of the indicator instead of building a strategy, because now once we have this edge, we can rank it with all the other indicators, and then we can take that indicator and build strategies based on our findings. Now, out of the 70,000 strategies that are in the database, only about 3,000 strategies passed my robustness filters. Now, I know this is not a fully developed strategy, but still you can judge if the edge is good or not. So I'm taking the edge through a robustness filter to make it pass or fail, and only 3,000 pass the test. And this is the database of the past strategies. So as you can see, we have 2,951 strategies that pass the robustness filter. This robustness filter is only for the edge. Those 3,000 strategies produce about 500,000 trades. So we're still very well in terms of numbers. Now, at the top here, we have the Williams R results. We have 169 strategies out of the 3,000 that passed the robustness filter. That represents 6% of the total number of strategies that passed the filter. And the trades represent about 9% of the total trades that passed. And at the top here, I have the ranking system for all the indicators that I posted so far in the Algo versus Scrap series. So we did Bollinger Bands, KCC indicator, CCI, MACD, RSI, stochastic, and Williams R. And like I told you, I already tested 22 indicators. Not all of them are posted on the channel, but currently Williams R sit at number 3. In fact, none of the videos I posted so far is in number 1 and 2 because I didn't post yet number 1 and 2. But currently Williams R sit at number 3, which is really, really good. And by the way, my indicator KCC percent sits at number 5. Now, what does this mean? So to give you an idea, this is the average performance of these strategies. So you can see we have return to drawdown of 3.8 with a net profit average of 53,000, average maximum drawdown of 15,000, average trades per year of 20, 60% win rate, average trade of 289, and so on and so forth. This again is not a strategy. These numbers are based on the 3 exits. And remember, one of them is exit the same day. Also, you can see the variety in Williams R. So these numbers at the top here are only for Williams R robust strategies. So we have 82 mean reversion and 87 breakout. So they are almost split in the middle. 105 long, 64 short. So this is almost 2 to 1. And these are the exit. Look at this. Exit end of day. 69 exit end of day. So even though we are exiting the same day, I have 69 exits end of day that are robust enough to pass the filters. And then I have 84 exit after 4 bars and 16 only that using the stop loss and profit target. And this is a little different from the average of all other indicators. You can see the average of the other indicators, the mean reversions are more than the breakout, and the long are a little bit more than the shorts. So with Williams R, the longs are a lot more than shorts, and the breakout are more than the mean reversion. And then for the exit end of day usually does better on average, but on our Williams indicator, the exit after 4 bars is the best. The takeaway, Williams R is one of the best indicators to use it for mean reversion or breakout strategies. You need to match it to the instrument. Remember, to get better results. And as I showed you in the first example, you can easily find a stable area to trade on your instrument. To watch more episodes of Algo versus Crap series, watch this video and I will see you there.